Okay. All right. All right. Understanding crypto by Kia Ghost. I want to thank the chance to credit V for helping me get this presentation rolling. I had he helped me with certain settings and whatnot for this presentation. So I want to give a quick thanks to him. This concept of trading is inspired by Richard D, ICT, and Larry Williams. Some of you might have heard those names before, and if you have not, you have now. So, getting closer to the truth, okay? We do not use patterns, okay? First of all, we're going to start with the rules, okay? We do not use patterns. We do not use indicators, reading, or momentum. We look for entries where retail sells, okay? We look for longs where retail sells. We look for shorts where retail buys. It's basically doing the opposite of what they're doing, okay? And I'm going to get further in depth with this. We anticipate price-seeking opposite liquidities. Time of day is vital when engaging with price. Because if you look at your charts, you see that there is what? Time and price. All right, so here is the Fibonacci settings levels for my Fibonacci. Copy this, take a screenshot, okay? Today's subject, we're going to be covering the time and price. We're also going to be covering the cycles of the market. We're going to be covering the natural cycle of the range. And we're going to be covering the bullish or bearish market structure shift and how to execute in certain trades. You guys took a screenshot? Is everything good? All right. Retail traders, often referred to an individual trader, buy or sells securities for personal accounts. Institutional traders buy and sell securities for accounts they manage for a group or institution. We are retail traders, but we do not think like retail traders. Price and time. All right, so we have the New York time at 7 a.m., 10 a.m., and then we have the London Open at 10 a.m. and 5 a.m. Now, this is an indicator, okay? Oh, wait, you told me you're not going to use indicators. Well, this is a tool, okay? It's not essentially an indicator. It doesn't read momentum or price. This is just a way of laying out your charts. So if you search in the ICT, if you search in the indicators, you write ICT kill zone boxes. There's about 2,421 people using it currently. Here is the settings for this indicator. Now you're going to have to put your kill zone to London Open at 2 a.m. in the morning. Then you're going to have to do the 5 a.m. right next to it. And then you have the kill zone for New York Open at 7 a.m. to 10 a.m. Now the box height is just leave it at 5 for what it is. And then if you look at the bottom right of your screen, there is the UTC, right? I want you to change it to New York because everything I will be teaching and the concept of ICT will be performed on New York time. Okay, not Los Angeles, not Vancouver, not where you're living currently. I want you to put it on New York, okay? Take a screenshot, take the time to understand this. London, yes, London Open. 2 a.m. to 5 a.m. in the morning. Excuse me. All right. So if you haven't taken a screenshot, do it right now because I'm about to change the slide. Okay. So what essentially this does is it marks out London's high and London's low. Or you can do it yourself. You can mark them out. You can mark out the London's high and London's low. Or simply use the tool I've just given you. And then you're saving yourself some time. Because once New York opens at 7 a.m. in the morning, they're most likely going to sweep under or above these highs and lows. If a sell-side liquidity from the London's low gets taken, wait to see an aggressive rally taking out a short-term low. This is only efficient if a short-term low gets rallied through aggressively and the daily bias is bullish for you. Now, we're going to be covering the daily bias and the weekly bias and the monthly on a different PowerPoint. This will just be an understanding on market structure shifts. In other words, you're looking for higher prices. Make sure there is a BMSS, bullish or bearish market structure shift. In this case, since we're expecting higher prices, it's going to be bullish market structure shift. Or it's most likely going to be a Judas swing. Most of you are probably wondering, what is a Judas swing? A Judas swing is a fake move that happens in between these time zones. So if you mark out the London, or you use the tool I've given you, there is a Judas swing under the 0000 New York opening price. Now, when the candle closes itself at 00 New York time, I want you to mark off the close of the candle all the way to the right, and I want you to write 0000 New York open. And what this essentially does, it gets you thinking. Now, a Judas swing is engineered price swing meant to lead reactionary traders into the wrong direction, typically false rally higher than the price. Emotional traders as the next bull run in price. So people think that is going to be a bull run, right? Because price is going upwards. Now what happens is the 0000 New York opening price opens, and essentially people go long in this area. Right away it crashes. So this gets emotional traders, people like retail traders, thinking. They're like, oh my God, I don't want to miss the next bull run. I don't want to mix Bitcoin going to 20,000. I don't want to mix Bitcoin going to the next 60,000. So I'm going to enter right now. I'm not going to do my technical analysis. I'm not going to talk about risk management. I am going to simply enter. Okay, this is what a Judas swing thinks. Judas swing is there to make you think that we're expecting lower or higher prices, and it's just a distraction for you to be on the wrong side of the market. So, many traders follow the Judas swing and find themselves trapped on the wrong side of the market. You've probably been here many times. I've been here many times. How do we avoid Judas swings? Wait for sell side or buy side to be taken, and then wait for a bullish or bearish market structure shift. Typically, there is a Judas swing when the opening price goes under or above your line at 8:30 and the 0000 New York opening at midnight. It's usually a Judas swing. So if we look at the 8:30 opening, there is a Judas swing right here. Do you see how price tends to reverse in these areas? Right here, right there at the openings. Oh, well, that's normal. It's buying, selling pressure. No, it's not. It's an algorithm. Okay? Now, here's the thing. If there's candles trading above your opening price, it's most likely going to go down. If the candles are trading under the opening price, it's most likely going to go up. Because why? If it comes under, you're in a discount. If it comes above, you're on a premium. If it comes both under these lines, the 00 New York opening price and the 8:30 New York opening price, and they're both under, you're in a very big discount. And you'll be looking to buy, not sell. All right. So now, most of you are probably asking, what is the bullish or bearish market structure shift? It is a market change. Okay, so I'm going to give you a understanding that is very simple. Okay, look at this. Look at this chart. Do you see how suddenly it stops here and there's a bullish or bearish market structure shift? In this area would be a bearish market structure shift because price draws down. It pushes down very aggressively. Now this is a new structure movement. Now we're expecting lower prices now since of this big move down. This would be our bearish market structure shift. A structural market change, broadly defined as a shift or a change in the way that the market or economy functions. It's basically we're seeing higher prices and then it shifts. It's a shift. It's a structural shift. Here, comes down, structural shifts. We start going higher. Okay, it is not a pattern. It is nothing. It is science. It's technical science. Now, we're going to go to the other slide. You're probably wondering, one of the first steps was wait for sell side or buy side to be taken. What is sell side and buy side to be taken? All right. Above old lows or sell stops. Above old highs or buy stops. Above old lows or sell stops. Above old highs or buy stops. Above old lows or sell stops, and above old highs is buy stops. Now look at this. We have taken far left, okay? Sell stops. We have taken a sell stop. We come under this line. Now there is what? A bullish market structure shift. Okay? Now, we're going to use the Fibonacci to identify this trend, okay? You're going to get the top wick, the highest wick. You're probably asking, why didn't I pick the one in the far back? Because I didn't pick this one because this is in the past. We're looking at the current price. And you draw it from the lowest point of the price, which is here. You're probably wondering why didn't I draw it here? Is because this hasn't happened yet, okay? We're looking at straight here to here, okay? You draw this out on time, and then you have your 50% premium. Now, the 0.5, when the price trades above this, it becomes a premium. When price trades under here, it becomes a discount. When it becomes a discount, you're looking for buys, okay? I'm not telling you to buy right away. You're going to have to do some more technical analysis to identify where you should get in. But this gives you an idea where the momentum is coming from. If we're looking for higher or lower prices. Now, put a little bit of lipstick on my chart, okay? You see that...
Yeah. Can I ask you one thing? There is like a thing where people can't see your cursor. Are you showing anything?
Oh, I don't think so. Okay.
Like,
Okay, so do you see, okay, I'm going to be a little bit more specific then. Do you see where I've underlined in yellow? So you're going to get the top of that wick to the bottom of that wick. See how I drew a red line? Now you're going to get the Fibonacci, okay? You're going to draw from the yellow to the other yellow. Okay, it's hard to show it to you because my cursor's like not there on the screen.
Kia, Can you read the voice chat bullet send you how you can show your cursor?
Open the PowerPoint presentation and go to the slideshow tab in the ribbon menu. Okay. All right. Okay, go to... Do you guys see the slide up tab anywhere? Slideshow. Nope. Okay. You see it? Group click cursor. All right. Okay. We're going to keep going then. It's okay. All right. So now that we have identified our sell side liquidity, okay, sell side liquidity gets taken away. Now we're looking to draw our Fibonacci. We're going to get the highest point of the chart, which is the wick that is drawn out yellow to the bottom of the current market price at the time. Yeah. So drawing this out on time, you see that there is what? We're under a discount. Now we're expecting price to go back up to a premium and then come back under to a discount, and then we would see a continuation to the buy side liquidity standing at the left side of the chart. All right, so here is the entry for this. Okay, so we have the New York opening midnight price. We have a Judas swing, drops price lower, and between 2 a.m. and 5 a.m. we have the London's low and London's high. Now you have a bullish market structure shift that pushes price higher up, but before doing that, you have to identify if this is actually a real move. Now, how do you do that? You draw your short-term low. Your short-term low gets taken. Now, Once that gets taken away, you officially have a bullet market structure shift. So from here, you're going to wait until candle 1 closes, candle 2 closes, candle 3 closes, which is the black candle right here, okay, which is the bearish candle right here. And you're going to draw your wick to the top wick. And then you're going to have this very big box, okay? So number 2 is the wick, the top wick, and number 2 is the big candle, which is the engulfing candle or the imbalancement, whatever you like to call it. Number 3 is the wick, the bearish wick, okay? And right above that, we have buy side liquidity. Because, why? Old highs are buy stops, okay? Now, we're starting to see accumulation in this phase, okay? First phase is accumulation, then we have manipulation, and then we have distribution. So if you look at this chart, you see that price is starting to go under. Okay, most people look at this as a continuation to the downside. We have a retracement, and then we have a continuation to the downside. But I see this as accumulation. Now, if you're looking, the chart is going downwards, bearish, right? What if I were to tell you that is a diversion? Thinking to make you go short, because it is simply just a retracement, right? And then price has another market structure shift in this area, okay, inside the accumulation, okay, and then we see a continuation to the upside towards the buy side liquidity. Now, if I'm putting more lipstick on the chart, this is on the 15-minute time frame, okay? London's low doesn't get taken away, but we see that there is a bullish market structure shift on the 50-minute time frame. Taps into it, accumulates on the lower time frames like the 5-minute. 8:30 comes in, Judas swing. This whole thing, that downward spiral, is a Judas swing. Then, if you look to the left side of the chart where you see relatively equal highs, there is a wick that is almost identical to the one right besides it. Now that is our buy side liquidity, our closer buy side liquidity. Price starts deviating away at higher prices, and now we have relatively equal highs. Breaks through it as the buy side liquidity, gets London's high, and then we go to the midnight opening price. Any questions on this one? Make sure to tag me if you have any questions.
Kia.
Yeah.
Do you record with the cursor? Like, does it show the cursor?
Yeah, the recording, yes.
Okay, also in Discord you can like change your screen share where you can like
I'll do that.
with cursor.
All right, so any questions on that?
Can you open the PowerPoint?
All right, so
Oh yeah, now it's good. Now it's really good.
okay, so I'm gonna actually go back and re-explain it, okay? Just to be safe, okay? So above old lows are sell side liquidity. Above old highs are buy stop liquidity. Under old lows are sell stop liquidities. Above old highs are buy stops. Above old lows, sell stops. Above old highs, buy stops, right? Then, so on, so on, so on. But you have to mark these out in price, okay? Here's a beautiful example. Sell side liquidity. This is actually the trade I took yesterday. Sell side liquidity comes in, grabs liquidity, right? Pushes price up. We have a bullish market structure shift. But before that, we want to draw out our Fibonacci. Okay, we want to get this wick. Probably asking why I didn't pick this one, because this is the current price. This is the closest one to the drop, right? This catches my eye more than this, because this is in the past. You don't look at this. You look at the current price, okay? This to the bottom of the market structure shift, right? And then somewhere in the middle, you're going to find your fair value gap. And we're going to get into that a little bit later in this presentation. Now, we have candle number 1 starting off with a almost indecisive candle. Pushing price up is the very big candle, number 2. Number 3 is a bearish candle. Okay, draw this out on time. You have this very big box, which is red, and it has an accumulation phase. Okay, this whole thing, the top of this bearish candle to the top of, I don't know, the bottom of this, for an example, is a whole Judas swing, making people think it's just a simple retracement and then a continuation lower. But if you know technical science, like me, you would know this is a market structure shift, and we're expecting higher prices now. No indicator is able to do this. Not one. Okay? We have a bullish market structure shift taking out a short-term high, which is officially now a new structural shift. Relatively equal highs. Draw this out on time. Here to here is now buy-side liquidity. Continue drawing that out after the 8:30 opening price. We have relatively equal highs, which is now what? Buy-side liquidity. Taking this out is a continuation to the upside at higher prices, buy-side liquidity. Now, here, after grabbing buy-side liquidity, it could keep going lower. It doesn't matter. We're out. It's that simple. We don't have to overcomplicate things. You don't have to be in a trade every minute. So here's the fair value gap that was created by the inner circle trader. Fair value gap is an imbalance between 3 candles. Okay, we talked about 3 candles right here. 1, 2, and 3. Draw this on time. You have your big box on the 50-minute fair value gap right here. Candle, bearish candle wick to the bullish candle wick, the indecisive candle right here. Then you have the very big engulfing candle in between. All right, so a fair value gap is an imbalance between 3 candles that can be used as targets as price tends to fill those imbalances, areas of liquidity, or it can be an entry point. Now, okay, so this is what I was talking about before. We have the market structure shift in between the zones. Now, this is a bullish market structure shift. No, it's not a W, all right? Because remember, we don't trade in pattern 6. The market will use and see this price delivery, a decline below old lows. Remember, what are old lows? Sell stop liquidities. Significant is placed on the term quick. And with a higher displacement, not small candles, you want to see a very aggressive engulfing candle. You want to see a big movement, okay? Like even here, this very big bearish downside candle, all right? This is an imbalance, and it does push price down. But that is not the narrative we're looking for. We're looking for higher prices. Now, same thing, we have the bearish ICT fair value gap, okay? Which is also made out of 3 candles. The idea of this is there's this displacement high and the displacement low. In between these are what? The fair value gap. Look, remember I told you to draw your Fibonacci, the top to the bottom. Then you have your displacement low and your displacement top. In between that, what is there? A fair value gap. And it's always there. It's always there. Same thing. Fair value gaps are even better when you have sell-side liquidity resting below short-term low. Okay? Whenever there's 2 fair value gaps, the idea is I'm going to let it trade down to the lower one. I'll sacrifice that better entry. And if it trades down to there, into it, okay, it comes to the lower bottom of another fair value gap, and it bounces away, goes to the higher one, then it comes right back up into the higher fair value gap. I'll enter on that one. So here's another example of an equal high, okay, or relatively equal high. Equal highs are more visual. They're better for buy-side liquidities. Relatively equal highs are the same thing, just they're not equal. They look equal, okay? So we call them relatively equal highs. Essentially, they're buy-stop liquidities. Definition, making retail traders think it is support or resistance. Then what they usually do is push price out of the zone, making them think it's a breakout. This is where they enter. Then they reverse price, tapping them on the wrong side of liquidity. It's basically like a very big Judas swing, right? Putting them on the wrong side of the market. P.S. Equal lows and equal highs, or relatively equal highs or relatively equal lows, can be buy stop or sell side liquidity. Now,